You know what's fascinating? While everyone's been obsessing over gold hitting new highs, something extraordinary has been happening in the silver market that almost nobody is talking about. And I mean nobody. The mainstream financial media? Silent. Your typical investment advisor? Clueless. But the smart money? They've been positioning themselves for what could be the most explosive move in precious metals we've seen in decades. Let me paint you a picture of what's actually happening right now. Silver just hit record highs, and here's the kicker. We're looking at the fifth consecutive year of structural supply deficits. Fifth year. Think about that for a second. 5 straight years where global demand has exceeded supply. We're not talking about a temporary imbalance here. This is a fundamental shift in the market structure that's creating a powder keg situation. The numbers are staggering. Over these 5 years, the cumulative supply deficit has reached 820 million ounces. That's not a typo. 820 million ounces of silver that the market demanded but couldn't produce. To put that in perspective, that's roughly equivalent to an entire year's worth of global silver production just gone, vanished from available supply. Now you might be thinking, okay, supply deficit, I get it, but why should I care? Here's why this is different from anything we've seen before. Silver isn't just a monetary metal anymore. It's become absolutely critical to the technological revolution we're living through. Every solar panel being installed to meet climate goals, loaded with silver. Electric vehicles that governments are mandating, they use significantly more silver than traditional cars. 5G infrastructure being rolled out globally. Silver is essential for those high-frequency circuits. Let me break down what's happening in the industrial sector because this is where it gets really interesting. Industrial demand for silver has been on an absolute tear. We're talking about applications that didn't even exist a decade ago now, consuming massive quantities of silver. The solar industry alone has become one of the largest consumers of silver globally. And here's the thing. These aren't discretionary uses. You can't build a solar panel without silver. You can't manufacture the circuit boards for electric vehicles without it. This is inelastic demand, and it's growing exponentially. But wait, there's more to this story. While industrial demand has been surging, something else has been happening on the investment side. After years of outflows, silver ETFs are seeing renewed interest. Institutional investors are starting to wake up to what's happening. They're looking at the supply-demand fundamentals and realizing that silver might be one of the most undervalued assets in the entire commodity complex. Think about the relationship between gold and silver for a moment. Historically, the gold-to-silver ratio has averaged around 60 to 1. That means it takes 60 ounces of silver to buy 1 ounce of gold. But we've seen this ratio swing wildly in recent years, at times reaching over 120 to 1. Right now, even with silver's recent gains, the ratio is still elevated compared to historical norms. What does that tell you? It tells you that silver has significant room to run just to catch up to gold, let alone if it starts to outperform. Now, let me tell you about something that's happening behind the scenes that most people have no idea about. The COMEX silver inventories, these are the physical silver stocks held in exchange warehouses, have been declining. Not gradually, dramatically. We're seeing drawdowns that suggest major players are taking physical delivery. When big institutions start pulling physical metal out of the exchange system, that's a signal. They're not doing that because they think prices are going down. Here's where the story gets even more compelling. The mining side of the equation is facing serious challenges. Silver production isn't keeping pace with demand, and there's a reason for that. Most silver, about 70%, comes as a byproduct of mining other metals like copper, lead, and zinc. That means silver production is largely dependent on the economics of these other metals. You can't just turn on more silver production when prices rise. It doesn't work that way. And the primary silver mines? They're facing their own set of problems. Ore grades have been declining. The easy-to-access deposits have already been mined. New discoveries are rare and take years to bring into production. We're talking about a 7 to 10-year timeline from discovery to production for a new mine. Even if silver prices double tomorrow, you're not going to see a meaningful supply response for years. Let me share something that should make you sit up and pay attention. Central banks around the world have been diversifying their reserves. We all know they've been buying gold at record levels. But here's what's interesting. Some central banks and sovereign wealth funds are also starting to look at silver. Why? Because they understand that silver has both monetary properties and industrial utility. It's a hedge against currency devaluation and a play on the technological transformation of the global economy. There's a historical parallel here that's worth examining. Back in the late 1970s, silver went on an incredible run. It went from around $5 an ounce to over $50 in just a few years. Now, I'm not saying we're going to see that exact scenario play out again. The circumstances were different, involving the Hunt brothers trying to corner the market. But what's similar is the combination of supply constraints and surging demand. The fundamentals today might actually be more compelling than they were back then. Think about the geopolitical situation we're in right now. We've got tensions between major powers. We've got concerns about currency stability. We've got governments running massive deficits and central banks that have expanded their balance sheets to unprecedented levels. In this environment, hard assets become increasingly attractive, and silver, with its dual nature as both an industrial metal and a monetary metal, offers a unique value proposition. Here's something else that's flying under the radar. The recycling rate for silver is relatively low compared to gold. Why? Because silver gets consumed in industrial applications. When silver is used in a solar panel or an electronic circuit board, it's essentially gone. It's not economically viable to recover it. This is fundamentally different from gold, where most of the gold ever mined still exists in some form. With silver, we're actually consuming the above-ground supply. Now, I want to take a quick moment here because this is important. If you're sitting on a substantial retirement account, we're talking 6 figures or more, you might want to pay attention to this. There's a strategy that a lot of people don't know about where you can actually hold physical precious metals in a retirement account without triggering tax penalties. I put together a comprehensive guide on how gold IRAs work, and it's available in the description below. It covers the mechanics, the rules, the potential benefits, and drawbacks. If you're thinking about diversifying your retirement portfolio with physical metals, it's worth checking out. No pressure, just information if it's relevant to your situation. All right, back to what's happening in the silver market. Let's talk about the paper versus physical dynamic because this is crucial to understanding where prices could go. The silver market, like gold, has a significant paper component. Futures contracts, options, ETFs that don't hold physical metal, these create a situation where the paper market is many times larger than the physical market. Estimates suggest that for every ounce of physical silver, there might be 100 or more ounces of paper claims on silver. What happens when people start demanding physical delivery? We've seen glimpses of this in recent years. Premiums for physical silver coins and bars have spiked well above the spot price. Dealers have faced inventory shortages. Mints have struggled to keep up with demand. This is a warning sign of what could happen if there's a broader move from paper to physical. Consider the investment demand side of the equation. Silver has historically been more volatile than gold, which means it can offer greater percentage gains in a bull market. But it also means it's been more prone to sell-offs. This volatility has kept some institutional investors on the sidelines. But here's the thing. As the supply deficit persists and industrial demand continues to grow, the fundamental floor under silver prices gets stronger. The risk-reward profile is shifting. Let me tell you about what's happening in the electric vehicle sector because this is a game-changer for silver demand. A typical internal combustion engine vehicle uses about 15 to 28 grams of silver. An electric vehicle? It uses 25 to 50 grams or more, depending on the model. And we're not talking about a few thousand EVs. Global EV sales are projected to reach tens of millions of units annually within the next few years. Do the math on that silver demand. It's substantial. And it's not just EVs. The entire electrification trend, from renewable energy to grid infrastructure to consumer electronics, is silver-intensive. We're in the middle of a technological transition that's fundamentally changing the demand profile for silver. This isn't a cyclical trend that's going to reverse. This is structural change driven by policy decisions, technological advancement, and environmental concerns. Now, let's talk about what the skeptics say, because it's important to address the counter-arguments. Some people point to the fact that silver has had false starts before. They remember the spike in 2011 when silver briefly touched $50, only to crash back down. They're worried about getting caught in another boom-bust cycle. And look, that's a legitimate concern. Markets can be irrational. Prices can overshoot in both directions. But here's the difference between now and 2011. Back then, the move was largely driven by investment speculation and concerns about the financial crisis. The industrial demand story wasn't as compelling. The supply deficit wasn't as entrenched. Today, we've got multiple drivers all pointing in the same direction. We've got structural supply deficits. We've got surging industrial demand from sectors that are growing exponentially. We've got investment demand starting to return. And we've got a macroeconomic environment that favors hard assets. There's another factor that people aren't talking about enough: the energy transition. Governments around the world have committed to aggressive climate goals. The European Union, the United States, China, they've all set targets for renewable energy adoption and carbon reduction. Meeting these targets requires massive deployment of solar panels, wind turbines, and energy storage systems. All of these technologies are silver intensive. This isn't speculative demand. This is policy-driven demand that's going to persist for decades. Let me share some specific numbers that illustrate the scale of what we're talking about. The solar industry is projected to consume over 150 million ounces of silver annually within the next few years. That's roughly 15% of total global silver supply going to just one sector, and that percentage is growing. As solar installations accelerate to meet climate targets, that demand is going to increase. There's no substitute for silver in solar panels that offers the same combination of conductivity, durability, and cost-effectiveness. Here's something that should concern anyone who's skeptical about silver's prospects. The major silver mining companies aren't investing heavily in new production capacity. Why not? Because the economics are challenging. Silver prices would need to be significantly higher to justify the capital expenditure required for new mines. This creates a catch-22 situation. We need higher prices to incentivize new supply, but the lack of new supply is what's going to drive prices higher. Think about the implications of that for a moment. We're in a situation where demand is growing, supply is constrained, and there's no quick fix on the supply side. This is the recipe for a sustained bull market. Not a quick spike and crash, but a multi-year trend of rising prices driven by fundamental supply-demand imbalances. Now let's talk about the monetary aspect of silver, because this is where things get really interesting. Throughout history, silver has been money. For thousands of years, silver coins were the primary medium of exchange in most economies. Even after the gold standard was abandoned, silver retained its status as a monetary metal. Today, while silver isn't used as currency, it's still recognized as a store of value and a hedge against currency debasement. In an environment where central banks are creating money at unprecedented rates, where government debt levels are at all-time highs, where inflation concerns are persistent, in this environment, the monetary properties of silver become increasingly relevant. People are looking for ways to preserve purchasing power. They're looking for assets that can't be printed or digitally created. Silver fits that bill. Here's a scenario that keeps me up at night, and it should concern anyone paying attention to financial markets. What happens if we see a loss of confidence in fiat currencies? What happens if inflation proves to be more persistent than central banks expect? What happens if there's a currency crisis in a major economy? In any of these scenarios, the demand for physical precious metals would surge, and given the supply constraints we've already discussed, the price response in silver could be explosive. Let me tell you about the LBMA, the London Bullion Market Association, because what's happening there is significant. The LBMA is one of the primary centers for precious metals trading globally. The silver vaults in London hold substantial quantities of physical metal. But here's what's interesting. We've been seeing drawdowns in these vaults. Physical silver is being withdrawn and shipped to other locations. This suggests that major players are repositioning their holdings, possibly in anticipation of supply tightness or price appreciation. There's also the question of China's role in all of this. China is the world's largest producer of silver, but it's also a massive consumer. Chinese industrial demand for silver has been growing rapidly, driven by the country's manufacturing sector and its push into renewable energy and electric vehicles. If China decides to restrict silver exports to ensure domestic supply, that would have profound implications for the global market. We've seen China take similar actions with other strategic materials. It's not far-fetched to think they might do the same with silver. Consider the investment landscape more broadly. Where can investors find genuine value today? Stock markets are at elevated valuations. Bond yields are low relative to inflation. Real estate prices in many markets are stretched. Cryptocurrencies are volatile and speculative. In this environment, commodities in general and precious metals specifically offer a compelling alternative. They're tangible assets with intrinsic value, they have limited supply, and they tend to perform well during periods of economic uncertainty. Silver, in particular, offers something unique. It's more affordable than gold on a per-ounce basis, which makes it accessible to a broader range of investors. It has higher volatility, which means greater potential for percentage gains. And it has the industrial demand component that gold lacks, providing a fundamental support level for prices. Let me share a perspective that might challenge your thinking. Some analysts are projecting that silver could reach triple digits, over $100 per ounce, within the next few years. Now, that might sound outlandish if you're looking at current prices. But when you consider the supply deficit, the industrial demand growth, the potential for investment demand to surge, and the historical precedent of silver's volatility, it's not as crazy as it sounds. Silver has moved 10x or more in previous bull markets. Could it happen again? The fundamentals suggest it's possible. Here's what's happening in the physical market right now that you need to understand. Premiums for physical silver products, coins, bars, rounds, have been elevated for an extended period. This tells you that there's strong demand for physical metal that's not fully reflected in the spot price. The spot price is determined by the paper market, by futures contracts and derivatives, but the physical market is showing signs of tightness. When these two markets diverge, eventually something has to give. There's also the question of silver's role in the monetary system going forward. We're seeing discussions about central bank digital currencies, about the future of money, about alternatives to the dollar-dominated system. In any scenario where there's a restructuring of the global monetary system, precious metals are likely to play a role. Silver, with its historical monetary status and its industrial utility, could be particularly well positioned. Think about the demographic trends as well. Younger investors are increasingly interested in alternative assets. They're skeptical of traditional financial institutions. They're concerned about inflation and currency debasement. Many of them have been drawn to cryptocurrencies, but there's also growing interest in precious metals. As this demographic cohort accumulates wealth, their investment choices could have a significant impact on silver demand. Let me address another skeptical argument. Some people say that technology will find substitutes for silver in industrial applications. They point to research into alternative materials that could replace silver in solar panels or electronics. And yes, there is research happening. But here's the reality. Silver's unique properties make it extremely difficult to replace. Its electrical conductivity, thermal conductivity, reflectivity, and malleability are unmatched. Any substitute would likely be more expensive or less effective. And even if substitutes are developed, it takes years for them to be commercialized and adopted at scale. The timeline matters here. Even if substitutes are eventually found, the demand for silver in current applications is going to persist for years, probably decades. The solar panels being installed today will use silver for their entire 25 to 30-year lifespan. The electric vehicles being manufactured now will contain silver for as long as they're on the road. This isn't demand that's going to disappear overnight. Here's something that should make you think. The world's wealthiest individuals and most sophisticated investors don't ignore supply-demand fundamentals. When they see a market with persistent deficits, growing demand, and constrained supply, they pay attention. We're seeing increased interest in silver from hedge funds, family offices, and institutional investors. These aren't retail speculators chasing momentum. These are smart money players positioning for what they see as a major opportunity. Let's talk about the geopolitical dimension because it's becoming increasingly relevant. We're in an era of great power competition. The United States, China, Russia, and other nations are jockeying for position. Control of strategic resources is part of this competition. Silver, given its importance to technology and defense applications, is a strategic resource. Countries that secure reliable supplies of silver will have an advantage in the technological competition that's defining the 21st century. There's also the de-dollarization trend that's been accelerating. Countries around the world are looking to reduce their dependence on the US dollar. They're settling trade in alternative currencies. They're accumulating gold reserves. They're exploring new monetary arrangements. In this environment, precious metals become more important as neutral stores of value that aren't tied to any single nation's currency or policy decisions. Now, I want to be clear about something. I'm not saying silver is a guaranteed investment or that prices can only go up. Markets are complex, and there are always risks. Prices can be volatile. There can be periods of consolidation or even decline. But when you look at the fundamental picture, the supply deficits, the industrial demand growth, the monetary environment, the geopolitical factors, the case for higher silver prices over the medium to long term is compelling. Here's what I think is going to happen, and this is based on analyzing the data, talking to industry experts, and studying historical precedents. We're in the early stages of a major bull market in silver. The supply deficits are going to persist and potentially worsen. Industrial demand is going to continue growing as the energy transition accelerates. Investment demand is going to return as more people recognize the opportunity, and at some point, we're going to see a price move that shocks the skeptics and validates what the fundamentals have been telling us all along. The question isn't whether silver prices are going higher. The question is how much higher and how fast. And that's where it gets interesting, because silver's volatility means that when it moves, it can move dramatically. We could see a situation where silver outperforms virtually every other asset class over the next few years. That's not hype. That's what the supply-demand fundamentals suggest is possible. So what does all this mean for you? It means that silver deserves serious consideration as part of a diversified portfolio. It means that the current price levels might represent a significant opportunity. It means that the skeptics who dismiss silver as a relic or a speculative play are missing the bigger picture. The world is changing. Technology is advancing. The monetary system is evolving. And silver is positioned at the intersection of all these trends. The smart money isn't waiting for confirmation. They're not waiting for silver to hit new highs before they act. They're positioning now, while the opportunity is still available, while premiums are manageable, while supply is still accessible. Because they understand that once the broader market wakes up to what's happening, once the supply tightness becomes undeniable, once prices start moving, it's going to be too late to get in at favorable levels. This is one of those moments in markets where the fundamentals are screaming one thing, but the price hasn't fully reflected it yet. These moments don't last forever. Eventually, price catches up to fundamentals, and when it does in the silver market, given the supply constraints and the growing demand, the move could be spectacular. The skeptics are going to be shocked, but those who paid attention to the data, who understood the supply-demand dynamics, who positioned themselves accordingly, they're going to be very well rewarded.